there's a question that keeps coming up in almost every serious investment conversation right now. How much gold and Bitcoin should you actually hold? Not in theory. Not as a thought experiment. But in a real portfolio, with real money, in a world where the U.S. national debt just crossed $36 trillion and central banks are quietly buying gold at record pace. Today, we're going to walk through what the biggest names in finance actually think: BlackRock, JPMorgan, Goldman Sachs, Ray Dalio, and yes, Warren Buffett, and then I'm going to share something a little more unusual, my own honest take, not as an institution covering itself with disclaimers, but as someone actually thinking through the decision. Let's get into it. First, the headline numbers, because they're more specific than most people realize. Gold, 5 to 10% is where mainstream institutional thinking has landed. This isn't the fringe anymore. According to WisdomTree's 2025 survey of European and UK institutional investors, average portfolio allocations to gold now sit at 5.7%, equal to their holdings in developed market sovereign debt. Gold has crossed over from hedge against chaos to genuine core allocation. Why? Because the classic 60-40 portfolio, 60% stocks, 40% bonds, is breaking down. Stock-bond correlation has hit historic highs, meaning bonds no longer reliably cushion equity drawdowns the way they used to. Investors need something else. Gold has filled that gap. Bitcoin, 1 to 5% is the institutional sweet spot. Notice how much smaller that range is compared to gold. That's intentional. JPMorgan's analysis found that just a 3.5% allocation to Bitcoin introduces the same amount of portfolio risk as the entire 40% bond allocation in a traditional portfolio. That's how volatile it is. The risk has to be sized accordingly. But the trend is clear: Bitcoin has moved from speculative curiosity to legitimate satellite position in the span of about 3 years. The launch of spot Bitcoin ETFs in early 2024 was a structural turning point. Suddenly, institutions that couldn't touch crypto for custody and compliance reasons had a clean on-ramp. Now let's get specific, because the institutional views are more divided than you might expect. BlackRock, the world's largest asset manager with over $11 trillion under management, published a paper called Sizing Bitcoin in Portfolios. Their conclusion: 1 to 2% is the reasonable range. Their reasoning is elegant: a 1 to 2% Bitcoin allocation contributes roughly the same portfolio risk as holding an average Magnificent 7 tech stock in a 60-40 portfolio. Go above 2%, and Bitcoin's share of your total risk starts compounding sharply. They're saying, small door, real opportunity, but don't let it eat the whole house. JPMorgan has been on an interesting journey. They've historically been cautious, and their risk math is sobering. That 3.5% figure I mentioned came from their research. But their tone has shifted in 2025. Their analysts have started writing about Bitcoin taking market share from gold in the so-called debasement trade, as institutions increasingly use Bitcoin to hedge against fiat currency erosion. Their long-term price models have become conspicuously bullish. Goldman Sachs sits on the other side of this divide. They're gold bulls. They raised their year-end gold price target to $5,400 per ounce, citing strong central bank demand and gold's far lower long-term volatility. Their positioning on Bitcoin is more muted. They've taken a stake, roughly $470 million in direct holdings plus ETF exposure, but it reads more like a client-driven concession than a conviction bet. Ray Dalio is the most dramatic case study, because he changed his mind publicly. In 2022, he recommended 1 to 2% in Bitcoin. By mid-2025, he had revised that to 15% combined in gold and Bitcoin, a staggering shift. His reasoning: the U.S. is caught in a debt doom loop, with $12 trillion in new Treasury issuance expected over the next year alone. In that environment, hard assets that can't be printed become structurally important. He still personally prefers gold over Bitcoin, but he's acknowledged that the specific ratio is, quote, up to you. What makes Dalio's revision worth paying attention to is not just the number, it's the logic behind it. He's saying that the traditional tools of portfolio construction, stocks and bonds, are increasingly caught in the same trap, both denominated in fiat currency that governments have every incentive to debase. Hard assets that exist outside that system become not a luxury, but a necessity. And then there's Warren Buffett, the great outlier. Berkshire Hathaway holds 0 gold and 0 Bitcoin. And Buffett has been remarkably consistent about why. His argument: neither asset produces anything. Gold just sits there. Bitcoin is rat poison squared. His framework is built on cash flow, productive assets that compound over decades. From 1942 to 2018, gold turned $10,000 into $400,000. The S&P 500 turned the same amount into $51 million. That asymmetry, he argues, is the whole story. The one exception was a brief stake in Barrick Gold, a gold mining company, in 2020. But it was sold within 2 quarters, and most analysts believe it wasn't Buffett's call to begin with. What's remarkable is that Buffett's position hasn't shifted even as gold surged 65% in 2025, its best year since 1979. That's either extraordinary discipline or extraordinary stubbornness, depending on your philosophy. But here's the thing about Buffett's argument that I find worth sitting with: he's not saying gold is a bad trade. He's saying it's a different game entirely. He's optimizing for compounding productive capital over 50 years. If that's not your time horizon, his framework may not apply to you. Now I want to be careful here. I'm not a financial advisor. I don't know your situation. What follows is how I personally would think through this decision, as a thought experiment, not a prescription. The first question I'd ask myself, is this money I genuinely won't need for 5 to 10 years? If the answer is no, I'd stop here. Both gold and Bitcoin can have before they recover. You need the time horizon for either to make sense. On gold, I would hold it. Probably somewhere between 5 and 10%. Not because I'm afraid, though fear is a legitimate input, but because I think the Buffett critique, while logically coherent, misses something important. The fact that gold produces no cash flow means it also has no counterparty risk. It doesn't depend on a company's earnings, a government's solvency, or a central bank's discipline. In a world where those things feel increasingly uncertain, that characteristic is a feature, not a bug. Gold isn't trying to do what stocks do. It's trying to do something else entirely. On Bitcoin, I'd hold a small position, 2 to 3%, and I'd think of it as a high-conviction asymmetric bet, not a hedge. Bitcoin's case is fundamentally different from gold's. It's younger, more volatile, more vulnerable to regulatory shifts and technological risk. The digital gold narrative is compelling, but it's still a narrative under construction. At 2 to 3%, if it goes to 0, my life doesn't change. If the narrative holds and it goes to $500,000, the return is meaningful. That asymmetry is the entire reason to own it at a small size. The one thing I'd caution against, and I mean this seriously, is making these decisions when everyone is talking about them. Right now, gold is at all-time highs. Bitcoin has crossed $100,000. Institutional reports are everywhere. That's exactly when the emotional pull to not miss out is strongest, and exactly when price discipline matters most. The best allocation decisions are made when you're calm, not when you're excited. So where does this leave us? The institutional consensus is converging around gold as a core allocation, roughly 5 to 10%, and Bitcoin as a small but legitimate satellite position of 1 to 5%. The old debate about whether these belong in portfolios at all is largely settled. The new debate is about sizing. Buffett remains the principal dissenter, and his long-term track record demands respect even when you disagree. And Dalio's dramatic revision, from 2% to 15%, is a signal worth taking seriously, even if you don't follow him all the way there. When one of the world's most rigorous macro investors shifts that dramatically, it's worth asking what he's seeing. My own answer: modest gold, very small Bitcoin, and always, always, more humility than certainty. Thanks for watching. If you found this useful, drop a comment below. I'd genuinely love to know where you personally land on this. Are you in the Buffett camp? Closer to Dalio? Somewhere in between? And remember, everything in this video is purely for informational and educational purposes. It is not financial advice. Nothing I've shared here should be taken as a recommendation to buy or sell any asset. I don't know your financial situation, your risk tolerance, or your time horizon. These are simply ideas and frameworks for thinking. The decision, and the responsibility, are entirely yours. Always do your own research, and consult a qualified financial advisor before making any investment decisions.